Valens Research, Uniform Financial Analytics.
So for those of you who don't know Integra, because Integra is off the beaten path for some people, I'm sure, especially since it's a $4 billion business, what Integra does is they make the implants that you use in particular for things like neurosurgery, right? The things that actually help you manage the surgery that you're doing and help people be able to survive afterwards. So when you look at here, the thing that we always see every single time that we come to a company under the Valens Research app, under the Uniform Accounting Framework, is we always come to this page. This page is what we call the Performance and Valuation Prime page, or PVP for short. The name really speaks to what it is that we're doing here. You'll notice we have a trend here at Valens. Pretty much all of the things, the ways we name things, we're very literal people. So for this, the goal of these charts, of this page, is to help you understand the performance, the fundamental performance of this company in terms of cash flows and investing, and the valuations for this company, right? Performance and valuation prime. Valuations, once you look at it from a uniform accounting framework, what the market's paying for this company. So looking at this chart, the first chart here is return on assets, or ROA. We call it ROA prime because it's our uniform accounting adjusted ROA are these blue bars. The orange bars are the as reported distorted return on assets for this company. Well, the blue bars are the uniform accounting adjusted true blue profitability for this business over the last 15 years. That's what these dark blue bars are, right? One of the first things that we can see when we look at Integra is how massively wrong the orange bars are for Integra. Under as reported accounting, you would think this name is a 5% return business, a very weak return business. In reality, it's a 25% return business. It's 5x higher in terms of its profitability than as reported metrics highlight. And just as importantly, on an as reported basis, it looks like this company has had flat returns for the last 5 to 10 years, right? Since 2013, returns have basically been between 4 or 5% on an as reported basis. In reality, since 2013, this company's returns have gone from 9% levels to 25% levels. They've almost tripled. But if you're looking at this company on an as reported basis, you don't see a company with massive improvement in profitability. You see a steady, boring business that might be growing, but it isn't expanding its profitability. And that's a problem, because when you think about analyzing this company's competitive moats, thinking about understanding its company's innovation and how successful it is, you'd be coming up with wrong conclusions looking at the as reported metrics, because you'd think it's a lower return business, its innovation hasn't been as successful, and it's a stable business, not an improving business, meaning they're not accelerating. But just understanding the returns is not enough to understand a business. We also need to understand not just how much cash is it throwing off, but how much is it reinvesting in itself. And that's when the next chart, which is the asset growth chart, comes into play. The asset growth chart, right, what we're focusing on here is how much is the company reinvesting in the business. The orange bars, again, the orange distorted as reported asset growth for this company, where the blue bars are the blue, true blue uniform accounting profitability of this business. What we can see here is there have been multiple years where as reported metrics massively misstated this company's in reinvestment. Quite frankly, in 2014 and 2015, you thought this company was massively investing in the business, and it wasn't. Similarly, since then, you thought the company's asset growth was mostly middling, right? Was mostly around, call it 2% plus or minus, with one big spike. In reality, this company has been aggressively investing over the past 3 years, creating value because it's been reinvesting into a higher return business. You can really think of the return on assets here as the operating cash flow this company is throwing off, and the asset growth as the investing the company is doing in the business. And so if we net these two together, you can almost think of this as a great way to visualize free cash flow for a business. And that helps us understand what profitability has been historically. Now, next is these light blue bars and these white bars, which are the most important thing that we highlight and focus on here at Valens, because it really differentiates the way we think about companies from how many do. These light blue bars are what sell-side consensus Wall Street estimates are for return on assets and asset growth for the next 2 years once we convert that data into the uniform accounting framework. The white bars are alternatively what the market is pricing in right now from a uniform accounting basis. So basically for IART right now at a $52 stock price and a $4.4 billion market cap, for this company to be fairly valued over the next 5 years, IART, which had a 25% ROA last year, needs to have a 15% ROA. And it also needs to be reinvesting at 8% a year, which is basically the low end of what it's reinvested the last 4 years. And so what we're focusing on here is trying to understand what is the market pricing in relative to history. And how do we come up with those white bars? We come up with those white bars with the charts below. The charts below, which are specifically focused on the company's valuation and what the market's paying for. And so what we can look at here is when we look at the VA prime, which is the first of these two valuation charts that we're focusing on, the VA prime highlights that we're actually looking at first the orange bars, the distorted as reported price to book. What this is telling us is what the price to book equity is for this company. What the blue bars are our adjusted price to book assets. We're looking at is what is the multiple, what is the premium the market is paying on a company's asset base. And you can think from this chart and the chart below, we can actually figure out these white bars. Because what we can basically say is if the market is currently paying a 4 times multiple on IART's assets, well, that means the market expects the company's return to be roughly 4 times what corporate average profitability is. Long run cost of capital, for context, right now, the real cost of capital in the US market is about 5%. So what the market is pricing in is for the cash flow stream to be basically 4 times that 5% level, or for it to be slightly below that, but for you to have growth. What we can see is the market's pricing ROAs to be roughly 3 times cost of capital, but with 8% compounding a year. So significant compounding too, which is why we get that, right? Because we're looking at what is the market pricing in. And then this last chart here is the VE prime. Well, this is our adjusted type of PE, right? So the orange bars are the as reported distorted PE, while the blue bars are the uniform accounting true blue valuation that the market is paying for this company. And right, you can see because ROAs are forecasted to drop, PEs have spiked higher, right? Which is important because it gives us context in terms of where valuations are. Then this final chart here is TSR. TSR stands for total shareholder return, the total capital appreciation and dividend income you could expect to receive in this company any given year. Well, the R, the little r, is relative. Relative to what? Relative to the market, the base index that we compare this company to. For IART, for Integra, that would be the S&P 500. What you can see here is when this line is flat, that means the company performed in line with the market. Whatever the market's appreciation or depreciation was, the company did too. If it rises here, that means the company outperformed the market. If it falls, like here, it means the company underperformed the market. And what we can see is there's a very strong relationship between the true blue trends and returns in investing and these type of trends, a kind of thing that we don't see when we look at the distorted as reported metrics, right? You can see here, as returns were strong and the company was reinvesting, right? TSR outperformed the market. When returns started to fall and the company was not reinvesting, TSR fell. When the company started to see returns expand again and was investing, TSR rose again. That just helps us with history though. The real question though is, what do we do with these blue bars and these white bars and these light blue bars? And that's what's really interesting about Integra. Because if we look at Integra and we stop and we think, if you remember what I mentioned earlier is Integra makes neurosurgical implants. That business has been starved this year of demand, right? Because of everything that's happened with the coronavirus, you've basically seen an environment where you have seen all elective procedures and all risk-taking activities that would cause people to unfortunately need to have brain surgery have been severely reduced. So Integra's seen its returns drop. But what's really interesting is the white bars here, what the market's pricing at a $4 billion market cap. The white bars say the market thinks that this is a perpetual issue for IART. The market says this isn't just a one-off issue from coronavirus. This company is going to consistently have lower returns going forward because of weaker demand. But if we step back and we say, no, we think that this company is actually going to see returns recover because it's not like we're not going to need to ever have brain surgery again after this. So I'm going to put a 25% ROA in here and then expect that it continues to grow as it has, as it's been innovating. And if I do that using the embedded expectation tool, I can quickly do a scenario to understand what's this company worth if it can deliver on that. If IART, if Integra can see returns rise back to where they had been before the disruption that truly for a company like this is likely to be short-term in nature, this company is priced to double. We could see 100% upside from current valuations. And that just quickly lets us help have the conversation to understand what should we expecting for this business, right? Because if we look at the as reported metrics for Integra, we would say, well, this is a middling low return business. Yeah, it's going to have a pressure, but it's not going to recover that quickly because of the fact that it's not a good business in the first place. It's only when we actually look at the uniform accounting that we can see, no, this is a growing high return business that's had a 1-year disruption. It makes no sense for that to just constantly happen for forever in perpetuity. And we have a very different conclusion for this name.
Valens Research, the world's leading source for uniform financial analytics.